So we're going to break this video down into three different sections. The first section is going to be what are fair value gaps. The second section is going to be how to identify fair value gaps. And lastly, we're going to actually speak about, which is the most important, how to enter off fair value gaps. The right way to get good entries, good signals from the markets and get basically sniper entries in the markets. Okay. Once I use these fair value gaps, since I introduced it into my trading, I have had literally entries where I barely am in drawdown. Literally barely in drawdown. If you see my trade recaps, you will notice sometimes I have trades where I am barely in drawdown, and that's because of fair value gaps. This has been one of my main confluences for entries for a very, very long time. And it is super, super important to get this right, because if you get it wrong, you will lose a ton load of money and you won't be in the right direction of the markets. So let's first speak about fair value gaps. What are fair value gaps? And I want to just put the camera on me for a second so I can actually explain to you what fair value gaps are. Fair value gaps are basically when you're in the market, we know that there's buyers and sellers. Now, fair value gaps, what that basically means is a battle between buyers and sellers, and we need to see who wins to continue the trend. So, for example, if we had a huge load of buyers come into the market, we need to now find the sellers for those buyers, because those buyers want to make money. They want to close a trade. So when they close trade, we now need to find the sellers for those buyers. So we then find the sellers, and we have to have the equal amount of buyers to equal amount of sellers. If we don't have the equal amount of neither, then there are going to just be a huge push to one direction. Okay, and let me just put it back into the markets so that you can actually see what I'm talking about. I'm a visual learner, so I like to visually show you this. So the market's gone up like this, right? We had buyers obviously enter from here or enter throughout this whole journey. Okay, what are we looking for? Well, if we're a buyer, we're looking for targets. Let's say there's a target up here. Soon as price gets to that, the market starts to push down. Why is that? Because a lot of traders are now selling here. Sell orders are here. A lot of take profits over here. A lot of traders are taking their move, and they're now probably either A, looking for more moves, or B, they're out of the market. What does that do? If buyers are out of the market, that means that the market is slowly going to start going down. Okay, so this is very, very basic, and I know we're kind of like speed running through these basics, but if you are a trader, you need to understand this. You need to understand why the market goes up, why the market goes down. Now, there are voids in the markets. I like to call them voids because these are areas where there's only buyers. Okay, so let's just say, I'm going to explain why, but let's just say there was only buyers within this area. What I mean by this is the market likes to do this, okay? Boom, 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 boom. And then there'll be a big move, and then it will continue. And you see with this big move, there's a gap. There's a gap in this big move, right? We want to highlight this gap, and obviously we identify it. This gap will then be called fair value gap. And let me actually just put it up right here so you can actually see it. This will be called the fair value gap. Now, when the market goes down, we want the market to go into this gap, into this void, because now we have something called buyers versus sellers. Okay? Buyers versus sellers. And so in this void, obviously we only have buyers, so we have to now find sellers, which you already found because of this downwards push. And now there's a battle between buyers and sellers. Now, usually if the battle is won by the opposite, so let's say, for example, here we're in an uptrend, of course, it should be buyers. But let's say it continues to go down. That invalidates that fair value gap. Therefore, the market is most likely going to go down. Okay. However, if the market validates this void and says, hey, buyers won, that is a signal for us. That means the market most likely will not come below this fair value gap. And therefore, price is going to go and tap these highs and other highs within the market. Does that make sense? Okay, so what fair value gaps are is basically voids in the markets where there was only buyers or only sellers, and the market has to come back into that void to obviously balance out the markets. And once the markets balance out and there's a clear winner, then we can then place our trade. Okay, so let's now identify fair value gaps. Okay, I hope that explanation made sense. I hope that explanation was good enough for you. But let's actually get into nitty gritty and actually learn how to identify fair value gaps. Okay. So let's just delete all of this. I'm going to try my best to draw this as good as possible. And I'm actually going to get out my rectangles to... Actually, no, I'm going to draw this out freehand. Let's do it. Screw it. Let's draw it freehand. So we got 3 candlesticks, okay? Fair value gaps are basically a 3 candlestick pattern, okay? And let's label these three candlesticks. And the reason why I'm drawing this out blank, I'm not giving it a color, is because it doesn't matter what color they are. It does not matter where they are going. It could be a bullish, bullish candlestick. It could be a bearish, bearish candlestick. It doesn't matter as long as it's going in a direction, okay? I don't know how, we will look at the candlesticks on the charts in a second, but I don't know if there's any other formations you can have it. Obviously, we can have bearish, bullish, bullish. I don't know. We'll find it in the markets if there is any other formations, but let's just say we have three candlesticks, okay? Doesn't matter what direction. Obviously, in this case, it is going down. We want to get the first of the low of, if we're going down, okay? Making sure this is only for down, because for up it'll be the opposite. The first of the lowest point of the candlestick, we draw a line like this. Okay, this includes the wick. I don't know why traders do not like to include the wicks. Wicks are just important as the body. Okay, so we include the wicks because that's where price was at. From here to here, this is where price is at. So you need to include the wicks, not just the body. The wicks are just as important. Okay, then we skip the second candlestick, and then we mark out the high of the third candlestick. This is for the low. Now, if these lines do not overlap, there is a void. In this case, the void will be for sellers. If it does overlap, so let's say it was like this, and they overlap, and this is what I mean by overlap, there is no void. Okay, the void was filled by this wick. So therefore, there is no fair value gap. In this case, there is a void. There's a clear gap between 1 and 3. This is the void. This will be the fair value gap. And what I like to do is I like to get the rectangle tool out. And I just draw a rectangle. It's super easy. You don't even have to draw lines. You just draw a rectangle. Okay. This is called the fair value gap. And I'm actually going to do it for the opposite as well. So let's just draw out one. God damn. That's a huge candlestick. Okay. 2. Boom. 3. Boom. Why is this one huge? Damn. Okay. Don't worry about why the size of this one's bigger than this one. Please, let's just follow it through. So if we're on an uptrend, it'll be the high of the first candlestick, the low of the third candlestick. That's a terrible line. Like that. We have a void. If we have a void, that is the fair value gap. Get your rectangle tool out. Draw that area. Boom. Like that. That's the fair value gap. Okay. Let's go on the drawing board. Let's write some notes down. Okay. So if we're bullish fair value gap, FVG. Draw a, no. This will be from the high point of the first candlestick and the lowest point of the third candlestick, comma, or full stop. If the area overlaps, then there is no FVG. That was basically when I said that if the line covers it up, the line covers this up. So let's say, for example, just take that out. Let's just say, for example, right here, if this line, if this wick was like as big as here, and obviously the low is lower than that, there is no void. Therefore, we have to obviously cancel out that fair value gap. There was no fair value gap. But if there is a void, this will be an area called FVG. Full stop. Okay. Same thing with the bearish fair value gap. This will be from the, it'll be the opposite. So it'll be the lowest point of the first candlestick. Again, include the wicks. Don't not include the wicks. Like, include the wicks when it comes to this. And the highest, so again, the opposite point of the third candlestick. If they overlap, if they overlap, I don't know why I wrote like that. If they overlap, then there is no FVG, comma, but if there is a void, this will be an area called a FVG. Okay, does that make sense? So we know what FVGs are, which actually let's write the definition of FVG as well. So definition of an FVG. This is where, bro, this is where there is an area of just buyers or sellers and price retests that area and begins a battle of buyers versus sellers to see if we can continue a trend. Boom. I think that's the easiest way I can define that. Okay, so what are fair value gaps? Check. We got the definition. How to identify fair value gaps? Check. We got that definition. Oh, we got that, right? Now let's just quickly go on the charts so that you can actually visibly see it with candlesticks, okay? So I like to look at fair value gaps on the 5-minute chart, okay? Let's get three. Let's actually look behind the scenes. Okay, let's do it here. 1, 2, 3. Okay, 1, 2, 3. As you can see, there is a void. I'll draw a line. Boom. This is the first. Let's make that black. Boom. First candlestick, the low, the high of the second. See, there's a void. Okay, price goes into this void. Boom, sellers clearly won. As you can see, like here, right? Market barely went into this void, like barely, but it did. Goes in there, short position. As soon as that happens, stop loss. We'll obviously talk about that later. But look at that, targeting the lows. Boom, smashed. Okay, let's go for more examples. Okay, let's go for here. 1, 2, 3. The low of the first, the high of the third. Boom, price goes in, comes out bearish, sell. Look how the market just crashes down. Okay, literally short that. Boom. Look at the way the market just goes down. Okay, let's get some harder examples. Okay, here, look, we actually have, okay, what do we do if we have stacked up fair value gaps? Okay, I'll actually explain that later on. Actually, no, I'll explain that now. Okay, if we have stacked up fair value gaps, 1, 2, another one here, 1, 2. And by the way, I like to use rectangles. I don't know why, just visibly, it just a little bit better. So over here we have stacked up, right? We have 2 fair value gaps. But as you can see, it respects the first one. Boom, doesn't matter. We remove everything else. It respects the first one. Therefore, it's good. But what if it disrespects the first one? What if it disrespects? Well, it doesn't mean the move is over. If it disrespects the first one, we just remove it. We wait for price to go into the second one. If it disrespects the second one, then it's the opposite direction. If not, if it rejects out of here and actually continues the sellers, this is still a retracement. This is still good enough. The only way you can destroy the retracement is if it either breaks all the fair value gaps or it breaks the high. And most likely it will break the high after that if it disrespects the fair value gap. Okay? So there's multiple times where the market will 100%, give you a move from these fair value gaps. Okay, 100%. Okay, now we had one more point, how to enter off these fair value gaps. Okay, so if I go back, right now price is actually coming into it, but I want that to play out. Hopefully before the end of this video, we can actually see some bullish move out of these fair value gaps. However, I want to show you something. Okay, so if I just show you this move right here, boom, one fair value gap, second fair value gap. As you can see, price goes in. As soon as we see bearish order flow, obviously because it's a downwards trend, as soon as we see bearish order flow, we enter. Okay, so we have to see a bearish candlestick form. Okay. Now, what do we do in this circumstance where we have stacked up fair value gaps? Well, I like to, if I'm playing a little bit aggressive, I can. But if I'm not, I will put my stop loss above all fair value gaps. So this is above all fair value gaps like this. And then I will target, obviously, liquidity lows. So I've got boom, one right here, boom, one right here. Probably even go lower. Probably even go all the way down to like here. Okay. Big stream, but look what happens. Price ends up hitting TP1, TP2. It ends up pushing up a little bit, but then boom, TP3. Okay. That's securing a 1 to 2.45. Okay. Boom. It's literally as simple as that. Okay, so just a keynote, write this down. When entering off a FEG, enter once there is a clear candlestick coming out of the FEG, full stop. Place stop loss above all FEGs. And then also target liquidity levels. Boom. 3 steps of literally entering off fair value gaps, okay? Let's get some more examples in. Let me show you how this works out, okay? Let's go a bit further back. This is obviously gold, so a little bit more volatile. Okay, here. Look at this. We have no fair value gap. We actually have a fair value gap here. Does price go into that? No, it does not. Fair enough. So no move would have taken place. Okay, here. This is a good move. Over here, you can see we had a breaker structure. Boom, push to the upside. Obviously, clear, big bullish move out of here. That's why it formed a fair value gap, a void of just buyers. Price is going to come in. We then get a big bullish candlestick coming out of it. That is a long situation for me. Stop loss, keeping it below, a few pips below the fair value gaps, or you can keep it below the liquidity lows or the lows, whatever is comfortable for you. Targeting liquidity levels. Obviously, we could target all of these highs, bro. Look at these liquidity highs right here. This would literally give you a 1 to 3 RR. Okay, sweep up, clean up, making sure we get a really, really good entry. Obviously, in this entry, we kind of got a little bit of a drawdown, but you know, look at the way it ends up playing out for us in our favor. Let's get another one. See if we can get some sniper entries in this market. Okay, yeah, right here. This will be a nice sniper entry. Boom. Again, a nice big bullish push. Price comes in. Big bullish push. Long position. Real good. Okay, over here, we can't put it obviously below. We'll put it below these lows. Look at this. Boom. Targeting these highs right here. These liquidity highs right here. And look what happens. Basically a sniper entry. 2 candlestick in 10 minutes. You just made a 1 to 2 RR. Things that most people find so difficult. Fair value gaps literally give it to you. Literally gives it to you, right? What else? Over here as well, bro. Fair value gaps are amazing. Now, this is a huge fair value gap. So this one right here is literally, we're waiting for this move right here. Boom, sell. Okay, in this case, we don't actually get our targets hit. Okay, look, this case, obviously stop loss above here. I mean, we technically did get our targets hit. So let's say this is our target, but we had a lot of drawdown. Like a lot of drawdown. I mean, do we even hit targets here? Okay, in this case, it didn't work. Fair enough. It didn't work. Okay, fair enough. But you know what? 1 out of 3, we're still making money in this game, right? Okay, here, look, again, a load of, like, look at this downwards push, bro. Yeah, so many people are trying to sell in this move. We're going to get that sniper entry, though, right? So what we're trying to look for is fair value gaps. I don't think price even hits a fair value gap in this move. No, it actually doesn't. It actually doesn't. I think the closest fair value gap we had was here. And price does not hit this fair value gap. Price just literally does not hit it. So we would have actually missed out on this big move. Fair enough. Fair enough, gold. Doesn't want to give us moves all the time. However, look, we would have still got moves within that day. Because look at this. Fair value gap right here. 1. And look, even though that's small, look how powerful that fair value gap is, right? 1, 2. We actually have 3 fair value gaps here. 3. Okay, look, first one gets respected, bullish order flow out, boom. This is long position right here. Look, respects, bullish order flow out, enter. Yes, we do get drawdown, but guess what? Stop losses are below all fair value gaps like this, targeting the highs. Boom. A little bit less of an RR, less than a 1 RR. I mean, was there any more targets we can target? I'm not too sure. I'm not gonna lie to you. I'm not too sure. Okay. However, we still get profits. Yes, there was a little bit of wicks, a little bit of drawdowns. Still get profits, man. That's how we want to play. So, just to tick everything off, we now know how to enter our fair value gaps. We now know how to identify fair value gaps, and we know what they are. Okay. I don't want to hear any excuses from you guys from now on that you are trading wrong with fair value gaps and you don't have good entries. Fair value gaps are literally one of the most important entry points within the markets. If you are still struggling with this, you can literally book a free one-on-one call with me. We're actually doing a 3-day masterclass. Actually, we're doing a 3-day masterclass. It's completely for free. If you're struggling with this, you need a bit more help, and you want a bit more like one-to-one kind of approach, click the link in the description. The first link, sign up. It's completely for free, and book your one-on-one call with me. We can talk about your trading, help you become a better trader, make sure that we see you actually get consistency. Other than that, if you want any help or if this works for you, comment it down below. If you like these styles of videos, make sure you comment down below. Like this video, subscribe, and I'll see you in the next video.